Now, shares of Salesforce are plunging in after hours after the company reported billings that missed some analyst estimates. For more on the numbers, let's bring back our editor-at-large, Cory Johnson. Cory, explain to us what this billings number means and why it's so important.
Yeah, and I'll say, we were thinking plunge when it was down 10%. It's only down about 6% now after hours, given the extreme valuation of the stock, trading over 700 times earnings. Well, that's not maybe as bad as you might think. Billings is an important number for this company because it's not just revenues, but it's revenues and deferred revenues, or the change in deferred revenues that was added in the recent quarter. And it gives a much more clear picture of exactly what was sold in the quarter. So when you look at the sequential change in billings, what you see there is the numbers going down. And so what investors want to see are numbers going up, and they want to see the percentage of which they go up to increase. So what you see here is a company that was growing so big and so fast and had so many imitators. When you start to see that slow down, some investors who only want to be there for the growth stage of a company, the hyper growth stage, they start to worry that that's over and they're getting out.
Now, we know Mark Benioff, the CEO, spending more on acquisition, spending more on hiring. Is that strategy working?
Well, I mean, the company turned a profit in this quarter, unlike the previous quarter. They use adjusted numbers, but the real GAAP numbers show a profit, the general accepted accounting principle numbers. And the company is still growing and still going to be a very big company, in part through those acquisitions. But it needs to grow to grow. It needs to add bodies to grow, and it needs to add other business lines to grow. One starts to wonder where the limits might be for this company if today is a sign that they're starting to approach.
Okay, Cory, hang on. Joining us now for more on Salesforce's earnings is Brad Zelnick, a senior analyst at Macquarie Capital, who has an outperform rating on the stock. Brad, curious to know what your take is on this billings number, how serious it is, and why it's causing the stock to drop so much in after hours.
Absolutely, and that's the right question. Billings is the leading metric that the street's going to look to, coming in at 28% year on year versus printed consensus at about 33%. And I frankly think the stock was discounting a bit more as it was well previewed and the street was expecting a beat. This is a disappointment, and for a stock that's priced to perfection, trading at 30 times cash flow, you can understand where this is a disappointment. However, there is a lot to like about what they showed us tonight, and there is some saving grace in being able to guide up next year for 28.5% revenue growth versus the street, which was about a 25%. And they actually gave us a glimpse into next quarter's deferred revenue growth, which is something very rare for the company. But I think they wanted to give a little bit more visibility and clarity to the nature of the business. It's not always taken to the balance sheet, to the income statement. And they gave a number that also for Q4 is way up, is up against where the street was. Essentially, their guidance implies 32% billings growth for Q4. The street was only expecting about 28%. So looking forward, there's a lot to like.
Now, Brad, I also want to ask you about Salesforce's PE ratio. You know, it's one of the highest out there, far higher than the S&P. I sat down with Mark Benioff a couple of months ago and asked him about it. Take a listen to what he had to say.
We are the fastest growing enterprise software company of our size in the world today. And in terms of market volatility and in the stock market and all that, what I've learned as CEO is I let the stock market take care of itself. I just make sure my customers are happy.
Salesforce trades at a premium compared to other like software companies. Brad, how much of a concern should that be for investors?
I don't think it's a concern at all, frankly. And I think you have to look at a company like Salesforce that's in hypergrowth, going after, not only going after, but leading a land grab opportunity. We look at cloud computing, we measure a market opportunity that by our numbers is low single-digit % penetrated even at this point in time. How do you measure a company going after it that's really only been constrained by distribution? You know, they've been investing aggressively, hiring up some of the best sales talent. We heard on the call from Mark Benioff, they took one of Oracle's top sales executives in EMEA during the quarter, and they disclosed that. So I really think you have to look at this company based on discounted cash flow. That's how we look at it. That's how we look at it over a 10-year time horizon, and we think that they can grow cash flows at a compounded growth rate of about 20% over the next 10 years. Given the size of this opportunity, the penetration, and the fact that Benioff and Salesforce are leading this parade, I think the stock is very reasonable.
Right, Brad, but let me bring Cory back into this conversation. You know, Mark Benioff is no question Salesforce's best salesman out there, but how much is the company's valuation dependent on his personal advertising of this company and the company fundamentals, Cory?
Well, I mean, I think what you have to listen to what Brad is saying. Brad's talking a lot about Wall Street. He's talking a lot about the growth game, the reaction to investors, whether the company's beating their estimates or the estimates are failing the street. What we're not talking about here is just what the company does. And we're talking about the machinations of the stock market. What we have with this company is a very different kind of software being sold in a very different way, in very different pieces, and it's growing fast. The market reaction, the growth of the company are two different things. The thing that's most interesting to me when I look at this company is, can they turn a profit? Can they generate free cash flow? And this quarter, from that respect, was a little better than the last quarter. But when Wall Street's expectations are through the moon in a stock like this, it's a stock story, not a company story, but the company is going gangbusters.
All right. Now, Brad, you mentioned Oracle. Oracle recently making more acquisitions, tromping on Salesforce's territory. Quickly, how much of a collision course are Oracle and Salesforce really on here?
You know, I have tremendous respect for Oracle on many dimensions. I don't think we can ever count Larry Ellison out. At the same time, I think you have to look at their track record in cloud computing. 3 years ago, Mr. Ellison came out and he told us that cloud is nothing but water vapor. 2 years ago, he came out and said, well, cloud computing is good, but we like private cloud platform as a service, which essentially translates to buy software as you always have from Oracle. More recently, we've announced the Oracle Cloud. They acquired Right Now, which plays in the service cloud arena where Salesforce is. So they are making overtures, but show me a tech company that's cannibalized itself to success. I don't think we can, we can really, take them seriously or really think of them as disrupting Salesforce at this point in time.
We'll have to leave it there. Brad Zelnick from Macquarie Capital, thanks so much for your insights.